Alright, so video number 2 today. First we had the diamonds found by Russia. Webbot report nailed it. And what I'm going to tell you now is I hope, just real quick back on the Webbot report, is that I hope when I go and look this report up real quick and I find that section about the diamonds, I hope that it gave a date and said, like 2013, we're expecting this, July of 2013, midsummer 2013, we expect an announcement by Russia. To where we all would say, oh, that done came and gone, it missed it. Because I always tell you on those Webbot reports, it happens over and over again where they give the date and time and it's off by 2, 3, whatever years. I mean, that long, but then it happens spectacularly. This is a spectacular hit. I can tell you now, even if there's not a date per se in that Webbot report of when this exactly was expected. The event has happened. And the way I always told y'all to look at the Webbot report, just understand the event, the thing it's telling you, and understand sometime in the near future you can expect it. That's how you play it safe with the Webbot report, because you can't rely on it to be spot on every time. It is only accurate like that time-wise sometimes, and it's out of Cliff High's control. It reports what it reports. He just interprets it and gives it out. But it's amazing to me, like this diamond thing is spot on accurate. It's unbelievably accurate. So having said that, this video is about derivatives. Some people, why is a derivative? How are these things weapons of financial mass destruction, so to speak? We've heard that term about these derivatives. How is that possible? What exactly are these derivatives, J-Snip? Well, first of all, they were created by the too big to fail banks themselves, namely J.P. Morgan's, what was the chick? Blythe Masters. I think she would talk about when they were in college and she was being interviewed and just giggling and laughing, having a good old time. They thought up of these derivatives contracts and how great they would be, and just loved it. She feels real confident, her and her little club, about creating these products. So a derivative, which many of you may know this, I'm going to go over it anyways, because when you see the financial system go down, it's going to be because of these derivatives, as Lindsay Williams correctly said. So, a derivative is a bet. It is a simple bet that is massively leveraged on some other financial product. And a lot of times, I'm going to say maybe most of the time, the financial product that it is a bet on is also leveraged. And what do you mean by leveraged, J-Snap? Well, if I tell you that you can give me $10 and make a bet against something else that you think is going to rise in price or fall in price. You can pick the bet. I think it's going to rise or I think it's going to fall. It's $10. It costs you $10 to place that bet. And your bet is saying, in this case, we're going to hope it goes up. So we're betting that this thing that I'm looking at, which is actually at $1,000, cost me $10 to bet, as if I had that $10,000 or that $1,000 to bet. So it's like I'm giving you $10 to bet with $1,000 worth of product, so to speak. And I'm betting that product's going to go up to $1,100. I'm betting it's going to go up $100 from where it's at. But it only cost me $10. So what I need to happen is I need the bet part of this, which is the $10, the derivative, to just go up 10 cents because of the leverage involved. Or better, no, that's a little too ridiculous of an example. $1. I need that $10 bet to go up to $11. If it can get to $11, That's a 10% increase. That $1,000 I just played with brought me in $1,100. But it only cost me $10 a play. Now I know I said $1,100, but I don't get to keep the $1,100. I only get to keep the $1,000 profit, or the $100 profit that I made. So remember, I was playing with the $1,000 that cost me $10 to play with. It went up $1, so my $10 bet went to 11 like I was hoping. Great, cha-ching, time to cash in. What my profit that I actually get is $100, because remember, I was playing with 1,000. It went up to 1,100, so I can take out that 100. You don't get the 1,000, but again, I played with $10. It moved $1, and I pulled in $100 for myself. What do you suppose it would be if I had a little bit more money than $10 to play with in this example, and I had $1,000 to play with? That same bet. $10 bets that we're talking about, but I had $1,000. So I put a whole bunch of those bets down. I will have just made thousands and thousands and thousands, several thousands of dollars off of $1,000 bet. Sounds good. Where do I sign up, man? This is a great thing. Well, let's just say that same scenario happens, even with the first bet scenario I gave you, where it moved $1. I thought it was going to move up $1, and I was going to pull out my $100 profit. And I was wrong, and instead of going down $1, it went down $3. So my $10 went down to $7, like that. Boom. Oh, crap. I just lost, each dollar is $100, right? $100, $200, $300. I just lost $300, even though the price of this stupid thing, right? Because now your mind changes. This stupid thing only went down $3, so why can't I just give him the $3? Right? I just want to give you $3 and make my account flip. No, sir, it's leverage. You got a margin call today because you went below the margin requirement. You need to put, not $3, you need to put $300 back in your account to bring that up to $1,000, you know, the betting part back to $1,000. Margin call. Same example as a second ago. I put $1,000 because I was doing this and I was right and I won some money before. I'm now going to put $1,000 worth of bets, of these $10 bets, again leveraged massively, and the same thing happens. It goes down $3. $10 goes down to $3. 30% loss. Now I'm getting a margin call. Remember, I put in 1,000. Now I'm getting a margin call for significant, I mean significant amounts, thousands of dollars margin call. I can't give you thousands of dollars margin, you know, brokerage firm. I don't have it. Well, we're going to sue you for it, potentially. And then I, as an individual who lost his rear end, let's say in this example, file for bankruptcy protection. And then, okay. So what ultimately happened in that scenario? I'm one guy, one example. I filed for bankruptcy. The brokerage firm that I was dealing with, who was getting little tiny fees every time I'd place those bets, they'd get the little skim off the top fees, loses because they can't collect the money from me. All was good when the prices were rising and everybody was winning. But then when people start losing, all of a sudden, as you can see, people start going bankrupt because they can't afford the margin call. And those small brokers who now owe the big guys the money because they were just the middleman for you to get to that financial product, derivatives contracts. They were just the middleman. So now they're going to have to file for bankruptcy protection because they don't have the money. But they had insurance through a company like AIG, who will promptly figure out that they, as an insurance company, don't have enough money to cover the losses that are now coming in. We're not talking about one little thing, one little silver contract collapsed today, price, and knocked a few people out. We're talking about all kinds of things collapsing, going down in price, and massive margin calls happening across the board. That's what we're talking about that's going to be coming. And in my example, these derivative products are absolutely leveraged. So when the pain comes, it hurts many, many, many times over because it's devastating, because it's leveraged. But my example that I mentioned was, well, wait a minute. We're talking about a derivatives product that's leveraged, and all it is, as you saw, is just a bet on some other thing. So let's just say there was derivatives contracts on the price of silver. Silver moves up from $14 to $15. Oh my God, massive profits. Thousands and thousands of dollars of profits. Silver moves down $2 or $3. Ouch. Multiple thousands of dollars in losses instantly. Margin call, give us the money. Again, imagine that scenario with all kinds of stuff: silver, gold, food commodities, stock prices, because you can get derivatives on financial products like certain stocks, interest rate things, anything paper. There's just about a derivative for. You can go and find one to bet on just about anything out there that's a financial product. So my question to everybody is, what happens when you have a massively leveraged derivative bet, or bets, because that's all they are. They're all leveraged. And the underlying asset, which is just another paper asset, a stock or a bond or interest rate thing, whatever, happens to also be leveraged somehow. So you have the original leveraging of the product itself. For example, let's say a futures contract, which is a silver or gold or commodity, just a commodities contract. They're also leveraged. But then you have these derivatives contracts on top of those contracts, betting on those specifically. You have a double dose of massive leverage. The futures contract was leveraged to start with. Then you have a derivatives contract, more bets on top of those. Can you see how this is going to end so badly? I mean, when Lindsay said it's going to be the derivatives that does this, the derivatives go down, they're going to mess with the interest rates, and that's going to be a key event. They did a little test with the interbank lending rate. He told me the dates. I found the dates. I found the news. It was exactly what he said was happening. They were all panicked by Monday morning. If this doesn't get solved, there's going to be chaos in the markets. China, such and such, lost $1 billion over the weekend. He said, relax. It'll be fine by Monday. That's what he was told. And by Monday, it was back to normal. Panic stopped. Nothing to worry about. It was over the weekend, of course. So it wasn't like markets were really open, but it was still enough for the interbank lending rate changed enough to where it affected things, whether it was a weekend or not. So that's what they're going to do. That's what they're going to use. And since so many derivatives contracts are written on interest rate vehicles of some sort, that means when the interest rates start to move, it'll be the equivalent of when I said, okay, this thing that was $1,000 moved up to $1,100, or in this case, my $10 bet on this item that was $10 moved up to $11, and I pulled $100 out of that in profit. It'd be the same thing. Well, the interest rate doesn't have to move like a full percent. Like, it can move 0.1%, right? So if it's 3% interbank lending rate and it goes to 3.1%, it'll have an effect. But it's not that bad. But if it goes another tenth and another tenth and another tenth, next thing you know, it goes a full entire percentage point. That's leverage. You could look at it the same way. And oh my God, are the derivatives contracts on interest rate products going to start collapsing? And then you have things like Greece happening, and they can't pay back the money, and the bonds are imploding, and there was a ton of derivatives contracts written on Greece, which is why they absolutely refuse to let Greece use the word bankruptcy. We can't file for bankruptcy because at that point we're insolvent, and that's when these credit default swaps and things, which are insurance on these derivatives, kick in to be paid, but can't be paid because there's too much money involved, and the insurance company will be insolvent immediately. So we got to do everything we can do to not call Greece's default an actual default and bankruptcy. We cannot use those words. We have to string them along as long as we possibly can until we're ready to let the whole thing collapse, which again should be September, October timeframe for the party to get started at least, because it has to be under their control, not anytime earlier or later. It's when they want it to happen. So, like Lindsay said, it'll be interest rates that they deal with change to cause these derivatives to really collapse, and it will be the derivatives that cause it. And at the end of the day, when people try to figure out what happened, you're going to turn on the news and they're going to talk about these complex financial instruments, product. The average person is going to turn on the news and say, what the hell? What is that? What does that even mean? What is that? What the hell's a derivative? I've never even heard of this thing. What is this? This thing caused the whole financial system to collapse. What is that? And they're gonna trust me. The news is gonna try not to tell you exactly what it was. They're gonna make it sound too complex for you to even care about. Just turn the channel. Just understand the market collapse. Turn the channel off. But the average person is gonna find out what exactly caused a derivatives problem. Interest rates. Okay. And they're gonna ultimately find out it was these derivatives that caused the mass carnage in the financial systems of the world. Now, naturally, anyone that got hit with anything they've never experienced before is going to figure out and want to know automatically, human mind, how did this happen so that this can never happen again? This is a worldwide problem. We don't ever, how did this, what is it? Okay, derivative. What the hell's a derivative? I better go find that out. And they're going to go immediately find the definition of a derivative and say, what in the F is that? You have to, who the hell designed this? When was this authorized? What government or entity on the face of the earth would ever allow something like this to be even used? And I'm going to wave the flag right behind them. Proud to, made in America. Everything else you have is not made in America. China, 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 made in China, 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 China. Derivatives products, cha-ching, stamp it. Made in America, baby. Our financial product, derivative, creation was created, it was created here. Think about this for 1 second. It's going to be the cause of the entire world's financial woes in the very near future. USA! USA! Oh, wait a minute. Not USA. Bad time to cheer for that one. Sorry about that.